Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our next topic, getting started with stock investing. Today, we will address the when to sell concept of this series in particular. Do look forward to kind of getting into some of the nuts and bolts with all of you. So thanks for being here today. See some familiar names and avatars in the chat there, as I often do. Hey to Jay Richardson and I'd Never Eat Here, David and Will. Great to have you guys. Obviously, I've got Michael Fairborn there in the chat as well. You can say hey to him. He'll try to keep an eye on questions that I'm unable to get to. Of course, I'm going to do the same. I want to address those questions today as we are talking the when to sell. We're going to be talking about some of the concepts that traders might choose to use, more specifically order types, stops, and trailing stops as well. We'll address both, but we're going to do so via the use of our example monitored portfolio so that we can take a look at maybe real world examples that will allow us to capture some of the upside we've seen and also address potentially some of the downside we need to make note of. But essentially, while it is talking about the when to sell, we will incorporate the portfolio, the example portfolio that is, in an effort to kind of really bring these concepts home for us, looking at real examples, real trades that we actually have on the table. So definitely want to make you aware of that. Now, additionally, before we kick off today, I do want to let you all know we got a couple weeks remaining in this particular series. Now, that is a change that's happening for us in our schedule as we move forward. So the Getting Started with Stock Investing webcast is actually going to shift to a new class being taught on Mondays at 9 a.m. Mountain Time, 11 a.m. Eastern. Our friend Scott Thompson is going to be taking it over. So that's a big change for us. One, taking it off of my schedule, but bringing you a new schedule of for me on a Thursday afternoon at 4 p.m. Eastern, 2 p.m. Mountain, where we'll be doing a more technical analysis based after the close conversation, one linked directly with the given day and how traders might look to set up the subsequent day based on potential setups that are viewable in the chart. So, that next class is probably 2 weeks out here. I expect that this class will be hosted next Thursday as well. I will probably be the individual hosting that one also. So basically, we're looking at 2 more weeks here before rotating this out to a Monday class for you. So just be aware of that, everybody. Some things under, just a little peek under the hood, if you will, about what we've got coming for you. So heads up. Also, there is a ThinkScript studies on Thinkorswim that is going to be taught here at that 1 p.m. slot. So this slot, as we go forward, is going to, in a couple of weeks, shift over to learning about ThinkScript. So I know many of you frequent attendees have a lot of questions about ThinkScript, want to get better and more proficient at utilizing ThinkScript. That class will be the one for you. I'll probably be a frequent attendee because it's an area of my familiarity with Thinkorswim that can also improve and grow. So I look forward to getting some new tidbits there as well. All right, so with that, let's get to our disclosures so that we can start talking about when to sell when we're thinking about our portfolio. Now, in terms of disclosures, remember that our conversation is always informational and educational only. We do not make recommendations here. We do not make endorsements for a specific strategy or approach to trading the market. Now, everything we do here is being done in paper money. Paper money does have some minor differences as to how it is going to work from a process standpoint. Going into order execution, for example, most commonly that's associated with option trading. We aren't going to be discussing options today, but we do want to make note of, and something I will say more than once today, is that the stop orders do not guarantee our exit price, at least not the traditional stop order, which does, once triggered, become a market order. We'll talk a bit more about that. We'll talk about an alternative method, the stop limit order, and then we'll also discuss trailing stops as well. But what you need to know about trailing stops is these are orders that are actually maintained on the Schwab server and do not get sent to the market maker, to the book, to the exchanges until triggered. That does mean that your details of that order, the trigger price and so on and so forth, none of that stuff is known to the market at any given moment. So that can be a bit of an anonymity standpoint, if you will, that allows those orders to be even more, potentially more protective. Now, obviously, again, we'll talk about some of those details as far as what you can expect from order types. So that's going to be our agenda today. What are exits? Why do traders employ exit strategies? We'll discuss some of those methods, of course, in doing so, and we're going to actually do that through the use of our examples. So as we work through a few concepts, the real takeaway, I think, for most of you, and many of you whose names are so familiar to me here, know that we talk so much about creating a plan when we step into our individual trades. Now, this class has not been built with a trade concept in mind, meaning we've been deploying money to take advantage of price action in the market, deciding to say, hey, we need a exposure to this group in the marketplace. We need to have money invested amongst those 11 sectors of the market to maintain a balanced portfolio. And further, some of those investments need to be small cap, some of them need to be large cap, and in an ideal world, some would probably be international as well. And I say ideal in the sense of working to meet a modeled approach for a long-term portfolio. I'll just remind you that if you're thoughtful about trade process, well, then these are concepts you're familiar with. But if you're not, many of you are investors and don't mitigate risk through the use of these exit strategies. Rather, you mitigate risk through that diversification approach to the market by having money invested in large cap and small cap and international and bonds, and then amongst large and small and international, making sure that you've got those financials and industrials and energy stocks and in tech stocks and so on and so forth. You need to have that balance. Well, today is going to be more likely tied to how do we conceive of utilizing short-term price movements to tighten the purse strings a little bit. If the market's gotten weak, a lot of traders, even with positions they wish to maintain, they start to incorporate exit strategies to protect capital. And protecting capital for so many is a major key component to being an active, whether it be a trader or an active portfolio manager as well. So we're just going to be providing some concepts and ideas to filter into your own process. Please choose the ones that make sense to you, and please choose percentages and concepts that not only make sense, but fit with your risk tolerance. And we'll talk more about all of that as we work through this. So what are we going to be talking about? Fixed stops, right? The idea that we place an entry and then we know up front, where will we move on? Where is our line in the sand that says we were wrong on this trade? And how do we thereafter utilize price action to move our stops to the upside? Notice I said to the upside, because if we are long the market, if we own shares of stock and have stop orders added, one thing that investors and traders are discouraged from doing is reducing or lowering your stop level, largely because you stepped into the trade or built a concept of how many dollars to expose, how many shares to own, etc., around the price action, and that's what led you to the position you have. Now, if you're in the process of watching your stock drop down to a stop support area and you're thinking, oh my gosh, I'm about to be stopped out, I don't want to be stopped out, commonly the relatively new trader will look at that and say, well, if I just lower my stop, I'm fine. And yes, you can lower your stop and you might not get stopped out, but it's just as likely that lowering your stop only results in you getting taken out at an even lower price for an even greater loss. And that's something we want to avoid. So yes, part of this stems from the original plan your trade concept, right? Plan your trade and then trade the plan that you've built for yourself. So the fixed stop is very basic, everybody. A dollar amount or a percentage amount under your entrance price, an amount by which you are comfortable. Set it and try to work from that. If it's a percentage, which is strongly encouraged, simply because when you think about prices, stocks that are trading at 25 bucks a share versus stocks trading at 250, quite a lot of discrepancy there. So if you, for example, like George, like the idea of an 8% stop at all times, work with 8% and stay consistent with it. That is just as important as anything else. Additionally, we will cover trailing stops. how do we conceive of these ratios? How do we decide to give up a certain amount from the peak at all times? It can be a bit more tricky to work with because the trail might mean that you are taken out prior to the true breaking of the trend. Not everybody wants to do that. So we'll talk a little bit about that as well. And then we have some basics that are always part of the conversation, everybody: support and resistance, and the potential use of trend lines to raise stop orders. So let's jump into our example portfolio. This will make a lot more sense if we start paying attention to investments we maintain in that example. So here we're going to sling into our getting started with stock investing portion, and we can see we've got a few individual equities in here, a couple of them working okay, others not so much. So let's sort by percentage and see that we've got some pretty decent returns. Adobe, as an example, doing well for us. We're up 17%. We do not have any exit strategies on these positions, everybody, and I know that because if I did, I would see some little coins over here on the left-hand side, or markers dictating sell or subsequent buy orders. If you had those in here, they would also be listed. So we have a few stocks that are doing just fine. We might want to raise or add some exit strategies on, I should say. And then we'll also look at some of these laggers as maybe stocks we could just move on from based on a shift in the trend from when we originally bought. So we can make some decisions based on some basics there. So let's start with Adobe, which I'm going to click on the number 5, and it's going to populate my chart for me here. So we've got a limit order. Oh, goodness, we've got an exit. And I guess I was wrong about this, everybody. I expected to see, let's see here. I expected to see that over here as sell, but it's not going to, I guess I was wrong. It's not going to appear there in my sell. I do have a sell limit on the Adobe position. It's up here on my chart, as you can see, at 425. So we got kind of close to it here about a week ago. Our high was 422.95, so we missed it by 2 points. So we have that as an available option. Now, we could also decide, you know what? I don't know if I want to stick with this longer than if it were to break the recent trend. This has been a good trade for us, a good example. And yes, I have that limit to sell the entire position out there. But if I'd prefer to be more protective in nature, perhaps I could look to be a seller under the 20-day moving average, somewhere in here. Now, for many of you, you'll ask that question. Why, Kevin, why did you choose the 20-day? Well, it's not to suggest that the 20-day is more important than another. It is to suggest that the 20-day seems to have been previously resistance until recently when we recaptured it back here in the end of April 25, as it turns out. We could work with that. So, a move under the 20-day moving average would be the first time in more than a month. And many traders would suggest that that would be a shift to the existing short-term trend and a level at which they would look to take profits. So here are two options available to us. We can maintain our limit to sell all 10 and hope to get up to 425, in which case we'd be taken out of our 10 shares. We could alternatively cancel this and place it with a stop order that won't give us an exit on the upside, but would give us an exit strategy if things got weak. So it's basically admitting, hey, we might have a new level of support in my white line zone here, right around 400 or so. And I want to be protected if that zone doesn't hold, but I don't necessarily need to be selling if the stock continues to move higher. So ultimately, we're just saying, hey, there's a new floor. And if that new floor holds, let's stick with it. Okay. Now, one other thing we could incorporate in setting our stop, and by the way, I'm going to go ahead and just cancel this sell at limit right now. The other thing we might choose to incorporate here, and many of you are familiar with it, it's average true range, so the ATR. I'm going to add that to my position in Adobe, and I see that today the ATR is $8.40. So an example of how a trader might incorporate this ATR would be to suggest that you come beneath the support you've set by the amount of the ATR. Now, that does not guarantee that you won't get taken out or stopped out erroneously. It absolutely can happen. But a trader would say, hey, if it traded by $8.25, if you will, below that 20-day, that's enough of a move beneath it where I'm no longer feeling that the intraday price action or the short-term weakness is something that's not more relative to the stock specifically. And that's what ATR is kind of designed to do. If you think about it, it'll give you more wiggle room, but more wiggle room can mean more risk. So this is something we have to bear in mind. And yes, Lizzie, great reminder. We have earnings coming. So earnings are here on the 12th. So one key component might be to say, let's put on an order to protect us if it falls beneath the 20 on a close. All right. But at the same time, many of you would say, hey, if it's above the 20 and I'm still sitting in profits and we're approaching the earnings window in the day of the earnings and you're thinking, you know what, I don't want to fiddle with earnings. I've got 15% profit. You could absolutely at that point choose to close your trade and not have the risk associated with the earnings. Always an available option for you. Remember, don't have to do anything by anyone's book other than yours. So think about how you like to handle these things. Do you like to hold through earnings? Do you not? And if you don't, well, don't feel like you have to stick with it because somebody on YouTube told you to, right? Stick with what makes sense for you, what makes you most comfortable. That is the most important aspect, if you ask me. Okay, so we got the 20-day moving average just shy of 400. Let's go ahead and say, let's put in an order at 392 for protection. Notice that 392 would basically be right to this gap zone, or pretty darn close to it, it looks like. So let's use the low from, I'm going to zoom in here to make this a little more visible, everybody. And again, when you're thinking about this, try and work with amounts with which you have comfort. Yes, if we get stopped out at 392, we are still going to be in profit, right? Let's see. There we go. Our average price is 351. So yeah, we would give up 20 points from existing right now, okay? But we would still be profiting by about 40 points, right? So we would be risking about 200 of our $600 of current profit. As long as we're comfortable with that, then the trade makes sense from that standpoint. And again, that's the step process that I do want you to give thought to. If this happens, how does my position look? How much of my profit am I risking? Is that more than I'm comfortable? Is that totally in line with my comfort? If it's more than your comfort, then some would say, hey, now is the time to take a little off, and now you can give it more wiggle room. Do the math one more time, right? So some thoughts for your consideration. So let's go ahead, and we're going to right-click in the chart here at about the 392 area. I'm going to go right-click and sell. So that's option one, by the way. You'll notice that my defaults are not set here. So this says sell 100 Adobe. That's not going to work. So I can do it from the right click, but a lot of traders like to do it from the monitor tab. And you'll start from just here, basically anywhere on the line. Just right click, create closing order, and this allows you to go directly from your order screen, right? So you can say stop. And here it's going to allow me to place the order. I'm going to make this good till canceled. And we discussed 392 as our approximation for that. So we're going to do a stop at 392. Follow through by just validating that I've done this properly. Good till canceled. What are we expecting? So trigger could be 392, but our exit price does not guarantee that. Remember, we could find ourselves gapping through 392. We close at 400 and open the next day. This is what can happen on an earnings window, by the way. This is why you want to be thoughtful about that earnings coming up. If we're in at 392, but we closed at 400 any given day, and then earnings hit and earnings are received poorly, and the next day it opens back at 350. At 350, that's our trigger, everybody. If the opening trade of the day is the first trade below the trigger we've set at 392, well, that open trade triggers us and we have a market order to sell. So in my example, if we opened at 350, we're going to get a market order to sell it's going to be much closer to 350 than it is our 392 stop. So we have to be aware that that is a possibility. Okay, Villager, great question I want to address here. You cannot currently set the stop specific to the moving average, and that's because of the moving average's dynamic nature. It shifts on a day-to-day basis. 200-day moving average shifts much slower than the 50 and much slower than the 20, and of course the 20 is slower than the 10 and so on. But what could you do if you wanted to incorporate something similar to the moving average? You might use a manually drawn line. You know, I've got my line drawn in here, and I can just right click and say, you know what, create an alert for me with that drawing. Notify me when the intraday price crosses below the trend line I've built, whether that's a horizontally flat trend line or the vertical trend lines that I like to draw. You know, you can do that here, be notified with a sound, have it play a sound here, right? And send my push notifications to my mobile. These can work really well for you. Yes, great question on that, Sia. Aren't they moving averages? Aren't these lagging in nature? Yes, they are. Not everybody's going to want to work necessarily with a daily moving average. In fact, this is something that I'm excited to discuss with you all down the road. I'm not prepared to do it today, but I will be, whereby we can talk around the use of a daily moving average incorporated into an intra-period breakdown for a stock. So we can, you know, create some differing windows of time, create some different moving averages value-wise, right? You know, like I say, we talk about the 20, the 50, the 200 so clearly here, but I'm going to wet your whistle a little bit, everybody. You know, if you were working with a 4-hour chart, well, notice here how on my 4-hour bars, this purple line, that's not just a 20, 50, or 200 day. That is a 52 period line. Over the last 52 4-hour blocks, Adobe has maintained the 52 period moving average. Now, why is 52 notable? Well, as it turns out, there are 8.125 for every 5 sessions of the week, or for the total week, right? So there's 6.5 hours in a day, in a trading day, 5 days in the trading week, excuse me. So we have 8.125 sessions, if you will, or 4-hour blocks. And if you divide 52 by 8.125, it essentially comes out to a full day. So what it is giving us is, you know, again, I'm going to give you all a much better breakdown, but what it's giving us is a cleaner way to use, in this case, that purple line, a 5-day moving average on an exponential basis on an intra-period chart. And I'm not going to tell you that it's 100% because nothing is. You all know that. But when you pay attention to what that line has looked like since April 22nd, have there been potential indications of why you would stay with it along the way until just very recently? Interesting stuff, right? At least I find that to be beyond interesting. The true trend of the intra-period could do a lot for us. So pretty fun stuff if you can. So we'll talk further about that. Like I said, when we get into the so-called after the market, or the class that I'll be offering up in a couple of weeks, we'll dive deeper into that. The use of these exponential moving averages over intra-periods of time to aid us a little bit. So the price where you clicked, great question, Ted. I can answer that for you here as part of our overall discussion. It is the line type. So when I right click on, click on the trackball in my mouse, I'm afforded a few options. I like the standard trend line because it has a beginning and an end always. But if you like the price level, which gives you the defined value, you just click price level, and then it's a double click, and you'll notice it places it over here. So even if I scale back, that number is there. You can always right click and edit properties, and you can show, whether you want to see the price on the left, price on the right, thickness and width of your line, so on and so forth. And again, you can utilize these lines. If they are manually added, these lines can be used to create alerts with your drawings so that you can be notified to place your trades, of course. Okay. All right. So there's your move on Adobe. Let's jump. Well, we're going to keep that large. Let's go back to our overall monitor page. We've got that sell order in on Adobe. There we go. Now it's appearing for me. I'm glad about that. Let's look at JP Morgan. Let's see what we've learned about the move here. We're up about 13% on JPM. We've got a whole 20 shares, and we are in at around 233 or so. So let's see how that looks on the chart. Now, as always, we could choose to add our order details in here. That's an option for us. But I'll tell you once more, when you see the action we've had in JP Morgan and how it looks similar to what we've had with the S&P 500, the NASDAQ 100, moving back through the 20-day moving average as recently as April 23rd, we noticed that we had a very successful test of the 20-day moving average. I say very successful because we've already bounced above it, right? If this is the low day in our trend, well, then we've traded through the high of our low day. And that's the first thing that must happen if we are capable of going higher still. So given the nature of this particular move, a logical location for a stop order is going to be just below the low we have set with that test of the 20-day moving average right there. Okay, so that looks like it right around 256. We could choose to incorporate the average true range down below, and average true range right now, $5.47. We could absolutely choose to do that here. So do we go, down to, instead of, 256, do we just say 250 for a nice logical round figure? Some would tell you stop orders, you want to stay off of these round figures. You want to use increments of pennies and odd pennies at that, not zeros, not nickels, etc. So that's a consideration, but not everybody's going to be worried about that. So why don't we try, and in this case, let's keep it nice and tight. So instead of, whereas Adobe, we incorporated the $8 average true range because we had that beautiful profit percentage, let's go ahead and try and keep this one tight, and let's see if it helps us out next week. So we'll go with something closer to 255 for our exit strategy. And so again, I'll just jump back to the monitor tab, right click, create closing order, and instead of limit, I'm going to say stop. And we're just going to designate 255, change that to good till canceled, confirm, and once more, the trigger at 255 is key. Our execution as a traditional market order thereafter could be at any available price. But I feel like this is an opportunity. So why don't we, instead of that, let's talk about the potential for a stop limit order, okay, which is designated right here. So stop and stop limit. Notice when I do choose the stop limit, I'm afforded two prices, right? The trigger at 255, and then what price do I wish to sell it at as we go forward? So that is to say, if I trigger at 255, instead of a market order to sell, I want a limit of at least, let's just say 250 a share. Okay. Now, does that guarantee me anything? No. But what it does state is, as long as I trigger and can sell for more than 250, remember it's 250 or better. So if we triggered at 254 and our limit is 250, we're going to execute at 254, pretty close to it, right? We're not guaranteeing that, but we know that our limit says at this price or better, just like every normal and traditional limit order does. Okay, so once more, it can't protect us entirely. We can't guarantee the price, but we can say that if you sell, it will be for this price or better. Hope that makes sense, everybody. So let's continue there. Let's go ahead and put that in with a stop limit on all 20 people. And there you go. So that one is at least relatively protected. We're working to protect and maintain as much of our profit as we can. I saw some questions in here quickly that I just thought I could address briefly. For those of you who are maybe thinking about this class a little differently, wondering about some of the scripting ideas. I'll tell you, again, I am not fantastic with the scripting. It's something that I'm continuing to learn about and build on. But one of the easier cheats, believe it or not, has been ChatGPT can provide some scripts for you. Now, it doesn't mean, as always, when we share scripts, we say it all the time, our scripts aren't guaranteed for accuracy. They're not guaranteed for timing. They're not recommendations for use. Similar to what you can get out of ChatGPT, though, believe it or not. So if you asked ChatGPT some very pointed criteria, provided it, and said, hey, this is what I'd like to do, you can cut and paste that stuff into the script editor here in Thinkorswim and cut, paste, and just give it a shot and see what comes out. Especially for the scanning tool, I've found it to be pretty helpful, to be quite honest. I was surprised by the level of assistance it offered. So, again, for somebody who's in the process of learning and wants to set that stuff better, so that I can make adjustments along the way. And once the criteria is set, then me playing with the criteria becomes starts to make a little more sense for me, which is, again, something that I'm just learning on the fly about. So maybe check that out a little bit. Believe it or not, it has worked. Okay. So we've got that protective order on JPM. Next, we're going to go back into the monitor tab, and we need to talk about a possible trailing stop. So let's take a look at Dollar Tree. Dollar Tree, we're up about 10% there. Not a huge position, but it's working. It's always nice to have positions in the green. So let's see. We were buyers on a break and retest. In fact, let us figure this out. Now, let us see a couple of details here. Eliminate that. All right. And then let us add back in our trade so I can see where we've placed Dollar Tree. All right. So we bought Dollar Tree at 81.69 on this. Wow. Always great to watch them in hindsight, but it's always fun when you see where you bought and then the stock has continued in the trend. Holy cow, we had a wonderful move. We had a bull flag to here. Flagpole, bull flag, broken right here. We bought before the bull flag or as the flag was trying to break, and the 20-day rising moving average has protected us and helped us out along the way. Excellent development for our trend. Now, we are potentially at an area of resistance. How does this line up? Oh, look at that. The peaks we've achieved managed to come pretty darn close to filling the gap at 91, didn't it? Or at least this area for a potential gap. So some traders are thinking, all right, we might have continuation here. Okay, we could absolutely conceive of putting a stop in beneath this, but we don't want to sell if the trend isn't necessarily going to break, and we would love to capture more upside. So let's consider the trailing stop. We need to give the stock a bit of a wide berth from where we are. Okay, we're going to call our 91 is approximately the highs. I don't think we got there. Our high was 90.76, 90.83, 90.77, and then today 90.47. So I'm just going to conceive of 91 as being our high. Okay, now we're going to add back that average true range, and we see that average true range is down to $2.76. Now, $2.76 is wider, or not as wide as the distance between our current price and our 20-day moving average. And so a lot of traders would say we need a wider berth. We want to give this stock an opportunity to fall, even intra-period, and maintain the investment. Okay? And what we are doing here, everybody, is to apply the approximation of average true range to our exit strategy, hoping that a breakout occurs and we can capture more upside and raise our exit strategy with it. Okay? And that's what the trailing stop does. Remember, the traditional stop requires us as the trader to lift it. We have to physically go in and adjust the exit order. However, the trailing stop doesn't require that of us. So we have a difference of $3.50 here to the 20-day moving average. So we're going to give this a wide berth, and we're going to go for a $5 trailing stop. Okay, now you can add this as a percentage if it's your preference, but a $5 trailing stop is going to be our goal. So we're going to go back to our monitor tab, right click, create closing order, and we're going to go with stop. Now I'm going to change the stop to a trail stop. Okay, change this to good till canceled. I do want it absolutely tracking forward more than today. My trail amount is $5, 5.00. Now remember, it won't tell you, you won't know what that amount is or what that actual level is until we execute this order, until we get this order on the tape, because it will initialize the last trade as the high of the day, or the high for the position, and then the math will be automatically 5 points beneath that last trade. And if the stock trends up, then we'll witness our stop trailing with it penny by penny. Okay, so same thing applies to the trailing stop order, though. Be aware, we can't guarantee that price. Once we trigger by falling 5%, $5 from whatever peak is established, okay, then we have a market order to sell. So if our high is 95, then our trigger is at 90. And if we closed it anything above 90 but opened the next day at 80, well, that first 80 trade is going to trigger us, and we're going to have a market order thereafter. So even the trailing stop is not a perfect order and cannot guarantee your exit price. All right, we're going to send that one off. It seems like I went through a little quickly on showing the trade here. Buy order on the chart for you there, Raymond. Let me get that in. It's right here under your gear icon, okay? And under general, so the very first thing you get when you pop up is show trades. So show trades there, and show orders up here in the upper left if you're looking to make sure that your existing open trades are notable there as well. Okay, so I think that gives us a few different examples on how to give consideration to working from your example portfolio, right? Working to protect ourselves. And oh, good question here, Neha. Can we use the trailing stop with a limit? Yes. So let's see. I've got Pfizer in here. That one's going to be nice and boring. Let's see about this. Nice and boring in the sense the ATR just dropping off the table, 57 cents. Maybe we give this one, $1.25. So here, I'm going to give you the example here. So you understand how we do that. Let's say, let's go back to monitor, right click, sell with stop. And let's say we want sell stop, trail stop limit. So here, much like I just got done explaining, we have that risk factor, right? That if we open below your trigger, we then trigger and have a market order to sell. Well, here you can do the, let's do a trail of, $1.25. But we want to sell, we want to make sure that it's at least over 20. That's all well and good. But it means, everyone, that if we triggered and opened under 20, let's say 1990, we are at the mercy of the trade. We are left to hold our shares until and if it can get back to 20. There's no guarantee it will. So that tells us that we, as the owner of the position, we have all the risk from where we opened under 20 all the way down to 0. Now, obviously, we don't think it can go down to 0, but we all know that every stock in theory can go to 0, right? So we have to be aware of that. By no means is that going to guarantee or protect us 100% of the way. So we have to give thought to it. And we've not only got to give thought to it, we got to expect that it's a possibility. And again, we have to utilize that possibility as a way of aiding us in deciding what is the proper order for us. I'm going to go ahead and put this one on, and let's just see how it plays out for us, and we can talk about it next week. Okay, So we did look at the various order types today, everybody. We've talked about the use of the trailing stop. In fact, we incorporated the trailing stop limit just now. Definitely an opportunity, but not the only one. Of course, we talked about fixed stops and the ability to set an amount by which you're comfortable falling and leave it in there. And then, of course, the recommendation that as prices move to the upside, we traders want to go in and adjust those stops in an effort to lock in those additional profits we might be seeing. So again, that's incumbent on us. Now, I have to mention before we go, when you're thinking about those trailing stops, everybody, the nice thing about a trailing stop is it will capture the upside for you, right? And if we go back to Adobe as a quick example, the trailing stop can be really helpful, but try and manage your position to the point where if you are taken out, even with your trail, for example, it is when it violates a level under which you would no longer have comfort. So that's why we started here with a basic stop under the 20-day moving average would be a big deal. We haven't been below the 20-day moving average for more than a month, almost 5 weeks. So that stands out to the trader, right? Whereas incorporating a trailing stop, if you get kicked out, it's entirely possible you could get stopped out before the 20-day gets violated because of a big spike to the upside. Now, that might be good because you're able to get taken out, you're able to take more profits, but not everybody wants to exit the trade before the trend truly ends. So I just wanted to mention that because I think that is something that falls by the wayside when we're thinking about the benefits of a trailing stop order. So be aware of that. If you don't have any concerns, if you're saying I'm more worried about capturing as much of my upside potential as possible, the trailing stop works for me. And if it stops me out for profit before the trend breaks, I can always get back in. Hey, that's perfectly fine too. That is an appropriate concept, but just know that that's what you're looking for. Know that these things can happen. Be aware of the various manners in which each of these individual orders can execute, can have an impact on you positively and negatively. Believe it or not, there is no perfect order out there. So knowing the intricacies is rather important for us as traders and investors alike. So hopefully this has been a helpful conversation, everybody. I want to thank you for joining and participating. Big thanks to Mike Fairborn there in the chat. Don't think we saw I did see a survey. It's way at the top up there, everybody. We have a survey opportunity. So if you don't mind, you can scroll up a little bit. I'm sure Mike will repost for us quickly here. But click the link. It'll open in the browser window next to this one. And just give me your thoughts on it. I will happily share these with our guy, Scott, who, again, is going to be kind of picking up this class beginning in 2 weeks. We're looking at the first Monday, which I guess will be June 9. So expect to see Scott hosting this on Mondays at 11 a.m. Eastern moving forward. And check this calendar as we do this rotational move for you here after the first week of June. So something to be on the lookout for there, everybody. All right. So with that, thanks for being here. Always appreciate you joining and participating in the chat. I love that stuff. I hope you all have a fantastic rest of your Thursday, and I look forward to seeing you all again real soon.